everybody. Welcome to another episode of What the FICC. I am Spencer Israel. This other guy is Ian Cully. He's the head of FICC, that is fixed income, commodities, and currencies at All Star Charts. And Mr. Cully, we got a lot to discuss today. We're talking about a strong dollar, which you think is going to be happening here. You think the dollar will be rising, and how to play a rising dollar, right?
Absolutely. Happy hump day, everybody. Halfway through the week. But yeah, dollar's been hanging in. Big sell-off heading into last weekend. And, bulls came back in, defended a critical level for the U.S. dollar index. So, I don't know. I got to give the dollar benefit of the doubt right now.
All right. Well, let's bring on some charts here of the U.S. dollar index, DXY, or Dixie as you like to call it, or it's known as. Talk about why you think the path of least resistance is higher for the dollar first, and then we'll get into some ideas on how to profit from a rising dollar, because a rising dollar is of course bad for stocks. So dollar rising, why?
Well, it's still holding above that 105 level, right? That's been the level we've been talking about. It lines up with a key retracement level from the last rip-roaring rally into the 2022 peak last September. And also you can see on the way up, acted as resistance briefly. I like to see that, right? Acted again as resistance earlier in this year during the spring. Now it's turning into support. So that's a principal polarity 101. As long as the dollar is below that, above that 105 level, got to give the dollar the benefit of the doubt. Now, said last week, it broke down out of a potential bullish continuation pattern. We call it a bull flag. So these tend to resolve to the upside. And when they don't, that's key information. Now the dollar's back in the box below this 105.50, 105.60 level that coincides with the early 2023 peak and the March peak. However, again, still holding above this critical 105 level. Now, what's interesting is the last time the dollar resolved lower from a similar continuation pattern, it ultimately went on to continue ripping higher, actually. Now, this is back in early 2021, had a bull pennant, similar kind of pattern to a flag, slightly different shape, more triangular like a pennant. Broke down out of that pattern.
Early 22.
Early 2022, broke down out of that pattern. Right? And what's interesting, it found support at a critical area of former resistance. Principle of polarity came in, bulls came in, and drove the dollar higher, right? As momentum remained in a bullish regime. So when I think back to early 2022 and similar action that we're seeing today, and I add on the fact that we just had a massive momentum thrust, 11 weeks in a row. I mean, that's a hot winning streak for the dollar index. And we go back over the past decade, those types of patterns tend to come in twos. You get an initial and a secondary thrust. Now, this is an initial thrust. Question is, are we going to get a secondary thrust? As long as the dollar index is above 105, I have to err in that direction, right? We saw two thrusts back in 2014, 2015, two thrusts. Again, one of those initial thrusts preceded this consolidation and breakdown. Here, another big thrust preceding a consolidation and a breakdown, and now the dollar's recovering. All right. So I want to give the dollar a little bit more room here, more room to dance. Now, taking a retracement of the recent leg higher off of that the July lows into the early October high, call it about 104 and a quarter. So as long as the dollar index is above 104 and a quarter, I want to give, again, I want to give it a little bit of room here, but certainly above 105, you can't be bearish the US dollar. Now,
So
yeah,
the crux of what you're saying here is the last time the US dollar had a consolidation pattern like we've had, followed by sort of a breakdown out of that pattern, it ripped higher after that, and also the last time or last several times we've had the number of consecutive weeks up that we've just had, that has preceded an uptrend. So
yes.
for those reasons, you're thinking that the US dollar is going to rise here probably in the next few weeks or few months or longer.
Or longer, yeah, absolutely.
Yeah. Okay.
And and momentum's in a bullish regime. Like, and on top of that, that's another key point, is that we haven't seen any signs of significant reversal. So I got to err with the underlying trend right now, which is higher for the dollar, as long as that breakout holds. Now, when it comes to, how do we trade a rising dollar, I think it always comes back to this chart. And this is probably shared this chart more than any other over the past, 6 to 8 months. And that's the US 10-year yield and the US dollar trending together. They've been highly correlated since the spring of 2022, when the Fed began to hike. Now, both also are currently in uptrends, and those trends have not reversed yet, though both rates in the dollar have started to turn lower. Both these trends are clearly to the upside. Now, if that remains intact, right? If this positive correlation, if it's dollar and rates heading higher together, then I think it can be as simple as, energy over tech. Right? This is another key ratio that I've been following, and that's XLE versus XLK. Now, what's interesting here is that it's not following rates higher. You see that the 30-year yield has continued to catch higher, and energy really hasn't followed. Now, there's a potential, significant structural bearish to bullish reversal favoring energy over tech that's underway, but still energy has a lot to do.
Could it also just be that the energy complex is so complicated that really there's more to it than just a rising dollar and rising bonds means energy over tech, right?
Yeah, I mean, it is more complex, and so is tech. So I don't think it's I look for patterns, I look for relationships, and this is a relationship that has been strong over the past decade plus, and it makes sense. Energy, oil, the inflationary assets. So if rates are rising and we're experiencing inflationary pressures, which we have, they should perform well. So with that in mind, just looking at commodities, it should be crude oil over gold. Right? Crude should continue to complete this bearish to bullish reversal. Gold and precious metals likely continue to struggle. That's what I imagine in an environment where the dollar continues to rise. Interestingly, crude oil has been catching lower lately. I don't know if you've been checking it out, Spencer.
I know this doesn't jive with what you're saying, Ian.
Right, I know. That's what we're going to get to towards the end here. Crude oil, potential failed breakout, heating oil, gasoline, the distillates never followed crude higher, never took out those critical resistance levels. Now, gasoline's trying to dig in at a former support level. I think that would be constructive. And heating oil is retesting some big levels on the weekly scale. We'll see what happens in the coming weeks, But when it comes, when it comes to just stocks, when it comes to equity plays, XLE is still range bound. XLE is still range bound. And these stocks, these assets have certainly outperformed crude oil over the past year or so. They've held up a lot better as crude oil sold off last year. But I don't think they're going anywhere if crude oil is breaking down below 83, which it already has. This isn't a good look for energy. Now, where's potential support for crude oil? I think around 75, 76 in that ballpark. It's a retracement level from this base, but crude's back in the box. Again, not a great look for energy. And then gold futures still stuck beneath overhead supply. Right? There's still a lot of work to be done for gold and silver. And looking at the risk-on ratios, or just risk ratios within the precious metal space, we're not seeing any flows that speak to risk-seeking behavior. Right? And when the best stocks, when the strongest gold miners are posting potential failed breakouts like Alamos is today, I mean, again, that's not a great look. So we're in a scenario where the best mining stocks aren't breaking out. GDX, the gold miner ETF, has yet to break out. Overhead supply for precious metals. But at the same time, energy really isn't favorable at the moment.
But and these are gold and oil. These are assets that should be rising with a rising dollar.
Crude oil should rise with interest rates. So as long as the dollar and rates, again, as long as the current environment we're in, where the dollar and rates are tightly correlated and are catching higher in tandem, crude oil should do well. Now, if that's the case, dollar and rates are rising, gold will come under increased selling pressure. Right? So just dollar above 105, 105.50, rates hold up, just remain elevated. You got to imagine it's energy over gold futures. You got to imagine it's energy over tech, possibly. That's a little fuzzier. However, looking at commodities, since the U.S. 10-year yield put in a significant pivot low earlier in the spring, it's really been energy again. As rates have been rising, energy has been outperforming, and the worst area of the commodity space has been precious metals. This is what I'm talking about. Now, in the near term, in past, I don't know, I want to say a couple month and a half since the dollar peaked and has been chopping sideways, base metals have really started to turn it on. So if the dollar just remains buoyant, right? Rates remain buoyant, but they just chop sideways. When we're looking at commodities and commodity-related stocks, I think the best place to turn for trading opportunities is going to be base and industrial metal plays. Here we've got, energy. And this has really been the question I've had, with energy catching higher in a rising rate environment, what's up with base metals, right? What's up with the other major pro-cyclical commodity group? They just haven't been participating. But copper's digging in, Freeport trying to dig in. Now, that would be very constructive if Freeport can dig in and catch higher. But I think we can look to these areas of the market. Now, the Copper Miners ETF COPX it's a ways away from last year's high around 46. And not necessarily anything to do here at the moment, but it's constructive. Same thing with XME. I mean, this area still, again, has a lot of work to do, right? 58.50, 58.60 on this chart here for XME, get back above there. I think the path of least resistance is up towards 80, 81. Still have a ways to go before that breakout. However, the steel ETF getting close to that breakout level around 68. I think we get above 68 and SLX. I like it long towards 100. I'd like to give it a $100 roll. Let's call it 110 for SLX. I think this could be the area that we want to focus on as a rotation takes place within the commodity space out of energy and into base and industrial metals, while the dollar and rates don't necessarily rip higher and don't necessarily break down. Right? So I always want to have a playbook for, upside, downside action and sideways action, because sideways is also a trend. People forget that sideways is a trend. So if dollar going sideways, rates going sideways, stocks overall, indexes, the S&P 500, Nasdaq's already doing really well. The Dow, they should do well. The overall stock market should do well. And when we're looking at commodity related stocks, I like the base industrial metals. I like the steel ETF right here, SLX. Also, Spencer, we've been talking about uranium a lot. I think uranium's also a good play. It's, it's out there. It's on the periphery. Maybe not quite as sensitive to these moves in the dollar and rates that gold or silver. So looking at the Sprott Uranium Miners ETF, URNM, I see an ETF that is reclaimed a key retracement level around 4250, and it's been consolidating constructively for the past couple months. As long as URNM is above 4250, I like it along with initial target up around 52, which is last year's pivot high. Secondary objective up towards 68. Here is a closer look at, this is the junior uranium miners ETF, URNJ. Another solid constructive base here, short-term base below 2450. Get back above 2450. Like it long towards 3150, like this base on base on base. And I also like that it's respecting these extension levels. It's always a good sign for managing risk or defining our risk.
Any individual names for individual stocks?
Last but not least, this is one of my favorites. I know Sean put a trade out on this one last month. Maybe it was the month before. Steve's been talking about this chart quite a bit. It's Next Gen Energy NX. It's a $3 billion uranium E&P name. And I think 650 is the level. When we get above 650, we're getting a potential double here up towards 13. Really like this name. Zooming in, again, we got a nice base, and it is, again, similar type of consolidation here, constructive near-term base below that 650 level. I really like buying a breakout here, and we got a bullish regime. It hit overbought on this recent leg higher. Bulls are in control. There's buying pressure. These are the type of names that I like. So this is where I think we could focus. Again, as the dollar and interest rates are kind of they're chopping sideways. And, yes, the structural, intermediate trend for the dollar, I believe, is still higher. It doesn't mean it's going to rip higher. It could be messy for longer.
A great question here from Dan in the chat. If you can go back to slide 3, Ian. We're talking about the US dollar, and you're making a point about the last time the dollar had the pattern that you highlighted in chart 2, which on chart 3 that goes back to early 2020. As Dan points out, when at that time, rates were coming off of zero. The Fed was raising the federal funds rate from zero, going parabolic, right? Aggressive rate hikes. And we're not really in an aggressive rate hike environment right now. We're still in a high rate environment, but not in a rate hike environment, right? So how does the fact that interest rates may have peaked, or at least that we are closer to an interest rate peak, impact your thesis?
I haven't seen anything in the charts that leads me to believe that we're anywhere near an interest rate peak. You know, that's what everybody's saying. I mean, that's
Right.
what's in the news. Like everyone, you know, I don't see it. I don't see it. But you're absolutely correct, Dan. Granted, didn't start hiking until I believe it was it March or April meeting.
The
But if it was
first hike,
April,
was the March meeting.
March.
That was
Okay,
the first
so
hike.
you know
Yeah.
it dug in, and the dollar started to rip higher, leading up into that to that meeting. And I guess the market looking forward and understanding that hey, Fed's going to have to hike. I also believe that that's what this 11-day winning streak was. And data comes out. It's been mixed, and now the market's trying to figure out whether or not the Fed is done. I have no idea. I have no idea the Fed is done. However, when I look at
Market seems to think so. At least the federal funds futures market seems to think so. Although if you ask Jerome Powell, he would say we're not sure. But
right. I mean, we need to see how things play out. I mean, the Fed funds future might lean in that direction, but that can change. That can change very quickly, and it often does. The 10-year yield in the U.S. dollar are on the fence, and this is after a steep rise. So, yes, it is very, very different environment to early 2022. 100%, Dan. We'll see how it plays out, but I don't want to join the crowd and just throw my hands up and say, yeah, inflation's dead. We've already hit peak rates and everything's going to roll over now. I'm not there yet. I'm not there yet until price proves it.
All right. So the bottom line is you're still thinking, just to recap, dollar likely to head higher here, mostly due to the fact that dollar has been highly tied to rates, and the rates seem to still be rising. So rising rates, rising dollar means, and we didn't really talk about stocks at all,
No.
means falling stocks, also means tailwind for commodities, but you are more interested in the metals catching up to energy complex. We saw energy outperform from whatever May to September, right? And then metals sort of start to catch up from September and October to now. So you're interested in gold, you're interested in gold miners, and I guess you
no. Let's clarify some things. First of all, I believe the dollar index, the path of least resistance is still higher for the dollar index because the dollar index is holding above 105. It has nothing to do with interest rates. Now, if interest rates and the dollar continue to trend in the same direction together, higher, then gold's going to have a hard time. Now, gold still has a lot of work to do, a lot of overhead supply. Miners haven't even broken out, and the strongest miners like Alamos Gold are posting potential failed breakouts, right? So I'm not ready to go get all bulled up there yet. Like I give credit where credit is due, but still got a lot of work to do there. Now, energy should be doing well in a rising rate environment, is struggling, right? So what do we do when in the near term dollar is messy, rates are messy? Look towards near-term relative strength. That's what I'm saying. In the near-term relative strength, we're finding in the base and industrial metals like SLX, and we're seeing the uranium space hold up really well too. So those are the areas that I want to focus on again in the near term as the dollar chops sideways, and then see as it catches higher. We'll see if energy starts to pick it up and play. Or maybe the dollar breaks down. Maybe this is it for the dollar. Maybe in the next couple of weeks, rates in the dollar start to roll over. In that case, we start looking at tech. When looking at tech, we want to look at the big, large cap, the big names. Again, I think heading in as we begin to reach out and take on more risk, I think we need to stick with the strongest names and relative strength. And I don't think there's any sense in going in and buying the weak names and looking for a catch-up trade. That's why I like SLX. That's why I like uranium.
Can
Does
gold
that make sense?
And yeah, it does. Can gold and silver rally if the dollar breaks higher? That's from Jonathan.
That's a really good question. I don't like to overthink the intermarket landscape. That's why when I see Alamos Gold break out above our risk level, I gotta say, hey, look, Alamos Gold's breaking out. Even though GDX really hasn't gotten going, even though gold continues to churn below overhead supply, even though the dollar remains buoyant and real rates are also elevated. It's a really good question. I think it can, but it's gonna have trouble. It's gonna have trouble. It's like looking at the S&P 500 and stocks just at the index level in general and saying it has a good chance of catching higher with a rising dollar. I don't think the chances are good for gold if the dollar continues to rip higher.
All right. This has been great, guys. If you want more analysis from Ian, the only way to get it is by joining All Star Charts Premium, where he provides all of his research to those members. You can do that by clicking the link in the description. He does have a blog as well. Link to that is in the description as well. And any questions, comments, concerns about anything related to the show, always email us questions@stockmarketmedia.com. We're going to end the show now. Coming up next is the Hot Corner with Steve Straza. He's going to work from his universe of stocks that have had insider buying and then rip through all those and see which of those have the best setups for a trade right now. That's coming up right now on Stock Market TV. Stay tuned for that. Ian, thanks a lot. We'll see you on Friday.
Thanks very much.
All right.
Don't let it rule you.